Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for August 31st, 2013. We are in a bullish normal market. On an annual basis, using weekly RSI 14, we're at 56 out of 100. On the 10-day basis, using the 10-day NDX, we're in oversold conditions at 14 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is 5.35%. That's yellow bullish and getting weaker. Slope of the 50 continues to decline to 0.11, which is red bearish. ADX 14 is at 23.5, neutral in trend, although it's getting very close to trending with bears in charge. ATR percentage got higher this week at 0.96, so we're still in the lower end of normal, but it's getting more volatile. The risk index, which is the 30-period moving average of the VIX divided by the 10, comes in at 0.89, which is a risk-off condition. That value of 0.89 has a z-score of minus 1.48 when you look back 5,000 days, for context. This is a 90-day time series of that risk index, and you can see we are at an extreme reading down here at almost minus 1.45. The last time it was down here, there was about an 8% rebound once the volatility declined. But it can stay down here for quite a while. It was down there for almost 10 days the last time we visited these levels. Blended monthly rebalancing holdings. The 32 ETF portfolio, let me actually work backwards. The 13 ETF portfolio, that's the conservative one, is IWM small caps, then US tech, then a third in cash. That's the first time that's happened for at least 8 months. The 22 ETF portfolio is the same basic conservative 13 plus 9 additional the XL series U.S. sector spiders, and that's holding XLY, technology, and consumer discretionary, XLV. And the 32 ETF portfolio is the 22 ETF portfolio plus 10 additional more volatile global and commodity ETFs. That is also holding XLY, the Qs, and XLV. The next reevaluation is due on or about 1 October. In ETF2, the theoretical exposure of the model is at 30%. The model portfolio is at 80% with stops in place. Uploaded some case study videos this week to the YouTube channel at Kennifer8. I've added this new look at volatility here. This is the 30-period price divided by the standard deviation. I'm sorry, the standard deviation of 30 days of price divided by price, and compared to the last 180 days. For context, you can see that we've bottomed out at quieter, now at the mid-range of normal compared to the last 6 months. Each time that's happened, volatility has continued on to get higher, so that possibility is always there. History doesn't necessarily repeat, but it does seem to rhyme. Just a quick look at the 13 and the 32 ETF portfolios. You see only the Qs and the Russell small caps are on a buy signal, and that's price relative to the 4-month moving average. And then probably only a quarter of the 32 ETF portfolio is on buy signals, the rest on cash. How quickly the world changes. This is the market health check. I've added a few new things here this week to help with interpreting. So the vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets that have been resistance in the past. The red horizontal lines are support levels that have held in the past. I've added this wide green channel. The center one is the 30-period regression line, lagged by 1 day, and then that's the RAF regression channel formed by the maximum excursion from that mean, or from that regression line during the look-back period, and that's basically one time horizon larger than the 30, which is this black series of lines and channels. I'm interested in the distance between the lower channels in each case. You can see that the 90-period channel is up, so the longer-term trending is bull. But this decline in the 30 is now bringing those two support levels, the bottoms of those channels, are getting dangerously close. And so I see this yellow space here as really the safety margin of the bull. If I extend this the 30-period regression line down here to the lower bound of the 90-day channels, it looks to me like this support level around 162 is pretty important. And then the bottom line is this 160. If 160 fails, the entire last 2 months have been a failure. And then it's look out for a quick fail down to 157. If 157 fails, really look out below, because then the 90-period trend will also have rolled over. And then we will be down near the 200-day moving average, which is just off this screen right here. You can see this this thin black line in the back is the slope of that 30-day regression line, and it's as bad as it's been in the last 6 months. A steep downward, in other words. You see ADX, the trend is starting to increase, and it's bears in charge. That's not good. Jaws of PPO have been pointing downward for about 2 months now. They gave us the alert around August 5th up in here. And still pointing towards more weakness ahead. So certainly not favorable for the long view. Although, the last time that we saw a move this far down, and that lasted 30 or 40 days, market responded with a retest at 171. So can that happen here with a higher low? Absolutely, things can happen. If that reverses to go north, then we're looking, it has to get through 156, but 157.5, and it essentially has to close above 171, really, for this to be considered an extension of the bull. But that can certainly happen in those time frames if we take a look at that. Notice how hard it has been trying to go back up. So it's been a steady decay here compared to a fast run up. Holding on tight, as the good Dr. Gil Raff would say, the market is holding on by its fingernails right here to preserve this bullish move. So this next week should be very, very interesting. Looking at the ETF2 regional report, only 3 out of the 10 regions are on a buy signal. That puts the theoretical model at 30% invested, 70% cash. That's a warning. The S&P is better than the globals right now, with the S&P at 69 compared to EFA is at 67, despite some strength in Europe. You see Europe's a little stronger than Asia with the score of 69 on the strength. Inside the U.S., the leaders are technology, small caps, large caps, then mids. Small caps and tech are the two strongest sectors in the world. Latin America and emerging markets continue just to get crushed. Inside the sector spiders, now we're down to 5 on a buy signal and 4 on a cash signal. Consumer discretionary remains the strongest, along with healthcare and industrials. This just already confirms what we've just said. U.S. is above average, with small cap growth the only exceptionally above average. Oil, because of the tensions in the Middle East. That narrow slice of China still doing very well. Netherlands continues to be strong in Europe. The rest of Europe is above average. The rest of Asia is below average or extremely below average. You can see the junior members are all getting crushed. And remember, about 4 months ago, those were at the very top of the growth list, and they've come considerably off those highs. The U.S. is slightly ahead or tied in all of the business sectors, so it hat tipped slightly to the U.S. The Aussie dollar continues to be remarkably weak. Quick look at the top ETF 30, no real change. The new strength coming into oil, Netherlands, commodity trusts, and healthcare and the small caps are green on strength and white on consistency, so that's new money coming in there. You notice the XLY, that consumer discretionary spider, still being remarkably strong, and there's U.S. tech now among the top 30 in the global opportunities. Looking at the Dow 30, Alcoa and IBM at the bottom in red. Hewlett-Packard has pulled back into the middle of the pack and actually into the bottom half. That's just how much it's been smacked down here lately, because it's yellow on strength and green on consistency. Money is also coming out of Cisco and American Express, so the leaders are rotating. United Health, Boeing, Bank of America, United Tech, and DuPont. Even money coming out of Johnson & Johnson here, which is green on consistency but white on strength. Liquidity snapshots. Notice that the emerging market index is now trading 20% more volume than the NASDAQ now. And the Russell Smalls are 1.5 times the volume of the Qs, so that's really become the trader's target. Shifting to the daily report from Friday for Monday. Taking a look here at lots of signals in overreaction and channeling, and if the market does find support here, those entries will look brilliant. I think they can be framed on a shorter term basis, and that's the way I'm going to play them. Lots of channeling and overreaction signals, the Qs on a 551W. Lots of good candidates in the auto framer. You can see that volatility has bottomed, has come back almost to the midpoint of normal. And ADX is still getting trendier, favoring the bears, and we're almost into a bear trend. Doesn't take much more. Hewlett-Packard almost 11 to 1, JP Morgan 4.5 to 1, Caterpillar 5.5 to 1 in terms of the auto framer reward to risk ratios. Lots to choose from there. Cisco has a 0 on a RSI2 value and a 2.5 on a reward to risk using the auto framer. Alcoa had an RSI of 2. The top 4 in the auto framer also were all in single digits on the RSI2 value, so the inverse VIX, Euro-Asia mix, Japan, and Europe all look to be very interesting. Silver at a 2-day low here was a percent loser on Friday at minus 1.7, has a 9 on RSI2. And that has been in a bit of a resurgence lately, and with a 2.1 in the auto framer, would deserve our attention. And the VIX, on the other hand, was the big winner on Friday. But even a 1.1% one-day return is not really exceptional for the VIX. So there wasn't a lot of conviction in the insurance and the hedgers there. Auto framer is self-explanatory. Lots of good choices here, all better than 2 to 1. A lot of familiar names. The primary trend is down. This polynomial curve suggests right here with those last 4 days that it's about fair valued. Right there is how I read it. It's the acceleration downward has slowed. The steepness of the 30-period regression line is still more than 2 standard deviations steep away from the 6-month average. You can see it's down here among historic lows compared to the last 180 days. The percent stretch above the 200 has come all the way back to the place just where it started the last great big move up. And if it does find support here, that higher low will make this in the long term look like an obvious buying area. It's not all that obvious when you're in the middle of it, but that's what the indicators are telling us. And the remainder of the charts are self-explanatory. You can see that it's fallen out of the river here. See the slope of the z-score of the 10-day regression line is rolling over. The 30 has fallen out of the river on a z-score basis, and the 90 continues to get dramatically weaker. When this red line crosses that 0 line, that could be another 4 to 5% loss. That would make that green 90-day regression channel we saw back on the health check go flat. So some real concerns. And the remainder are just reference charts.